Know the difference with Annex Wealth Management, joined by Matt Morzy, Director of Research with our in-house investment team, also a CFP. Good sense of wise and prudent investing. You like that one, Matt? Welcome back.
I do. Thank you, Danny.
We're going to talk about diversification when it comes to investing. Now, you're way too young for this, but there was a movie called Love Story, and the phrase, love means never having to say you're sorry, became an icon in the 70s. When it comes to investing, you told me that the phrase diversification means always having to say you're sorry. You got to decode that.
I was unaware of that movie quote, so thank you, Danny.
Well, your mom will know.
I'll have to ask her. But what that really means is that when you diversify, there'll be parts of the portfolio that are doing really well and others that are just not keeping up. For many investors, that can be really frustrating that not everything in their portfolio is beating their benchmark. But that's really the goal in diversification, because when the markets sell off or we have volatility, it's likely that what was just trailing is now holding up better and helping reduce how much your portfolio is down.
Let's talk about diversification, why and how, and there you go. It's balance, right?
It is certainly balance. Diversification in investing is really a strategy in terms of spreading your investments out across a variety of different asset classes. Things like stocks, bonds, potentially even real estate or commodities, to reduce risk. The idea is that by not putting all of your money into one type of investment, you smooth out your overall investment experience.
There's a lot of stuff to consider.
There really is, and there's different levels of diversification as well. So stocks versus bonds is kind of like that first one that most people think about. And so for instance, like you might have heard about the 60-40 portfolio. It's a popular allocation designed to represent one who's kind of a moderate investor. They're not too aggressive, yet not too conservative. And their portfolios can be 60% stocks and 40% bonds. It's based on the principle that different assets tend to perform differently under various economic conditions. For example, when stocks are down, bonds might be up or vice versa.
Okay, let's talk about the second level of investment diversification. What's within the stock portion and what's within the bond portion?
Exactly. So you're starting at that 60-40 and then you're kind of moving your way down. So within the stock portion, you might have U.S. stocks and international stocks. You might have some growth stocks, some value stocks, maybe even some large companies and small companies in there as well too. But essentially you have a diversified basket inside of another diversified basket. Same thing with bonds. You might have safer bond investments like U.S. Treasuries, for example. You might have some more that are more aggressive or riskier, like high yield bonds, things that are more credit sensitive as well too. So you're trying to balance out within each portion of that.
You need those bonds, and it's funny because they might not get the respect from a general public, right? Nobody sits around and brags about bonds.
Almost nobody, that's for sure. The bond market is actually much larger than the stock market is, but yeah, it certainly does not get the same amount of publicity on CNBC and things like that. But it's really there to help provide some stabilization to your portfolio, hopefully income as well too. Now that yields are higher, that's a little bit more easily attainable. But, it's there to balance out the risk within the stocks.
Yeah, because you want that, right? Diversification can help manage risk, but it's not a guarantee.
That's correct. It's important to note that while diversification can help manage risk, it does not guarantee against loss or ensure a profit. The strategy really is trying to aim to improve your risk-adjusted returns over time by limiting exposure to any single investments or risk.
So when a portfolio is reviewed at Annex, how quickly can you spot lack of diversification?
Yeah, in some situations, it's essentially immediately. We have a lot of different resources that we have available at Annex that we use on our internally managed portfolios that we do to really break down what a portfolio looks like, not just at a top level of what investments that you have, but what are the exposures within that portfolio as well too. We can use the same stuff on people who are not clients of Annex and take a look at what they're doing. A lot of times those might be portfolios that they're managing themselves or maybe another advisor managing for them. And we could take a look at them and really see how they're truly invested. But sometimes it's really simple just by looking at a statement and going, well, you have 5 stocks and they're all part of the Make 7. So they're very highly correlated with each other and you're missing a lot of other things. That might have done really, really well for a long period of time lately, but the risk there when that portion of the market pulls back is really, really high. Same thing could be even with ETFs and mutual funds that people think are diversified because they hold a lot of things within it. But if you're holding 3 ETFs that are all like the S&P 500 or very close, you're not actually diversifying yourself at all. They're all just the same investment. And what we do is really look underneath the hood of all those ETFs and mutual funds and see what they're really holding to see how really you're positioned.
And most portfolios, they can get out of whack, right? How do we trim? How do we prune when needed?
Yeah, that's a great question because over time, whatever your target allocation is going to change because of the market. So going back to that 60-40 portfolio, that might be what your best portfolio is for your level of risk tolerance. But if stocks do really well, that's going to naturally move and it might be 65-35. and then 70-30 if you're not rebalancing. And although that's great during that time period when stocks are rising up, well, when we get that pullback or we head into a recession and it all naturally goes back to 60-40, well, you just lost out on all the gains that you just had. So what we really want to do is monitor that level of risk you're taking, see what the portfolio is doing, potentially start trimming positions as they're going up. And we're going to be okay with that because we're managing the level of risk you have. But also we can look for, maybe more organic ways to manage that too. So let's say you put new cash into an account. Well, we're going to buy the things that are down, that had been detracted from your performance to get you back to where you are. Or maybe you need money to come out of the account to pay for something. Well, we're going to sell the things that had gone up over that time period and trim that back to where it should be in order to raise that cash for you. And when you're doing that, you're basically forcing yourself to buy low and sell high, which is really the objective when it comes to investing.
Matt Morzy, Director of Research, also CFP, part of the in-house investment team at Annex. Thanks for joining us.
Thank you, sir.